Tangible asset management is a section that I know many students struggle with, but it's actually one of my favorites. I've got a couple of tips and tricks up my sleeve that will hopefully help you see how easy it really can be. In an exam, it is usually given as part of another question. I've hardly ever seen it as its own question. So it could be part of financial statements, or it could have implications with VAT. It could be combined in a cash flow, etc. Couple of concepts just to get you going and make sure that you've got the proper grounding. When you buy new assets, it's very important to understand that the cost of an asset is actually the total cost involved in bringing that asset to the condition and location where it is needed to be used. In other words, it is the purchase price plus any other costs to become operational. So that could be a delivery cost, an installation cost, a registration cost, etc. Depreciation concepts. Firstly, I've just mentioned that the cost is the total cost to get the asset where you need it and how you need it. Something also to keep in mind is the residual or salvage value. That simply means what is the item going to be worth at the end of its useful life to the business. So not the total end of its life, not just the scrap value, but you might only need an asset for a couple of years and then you sell it on to somebody else who can still use it. It's whatever you could sell it for. Or yes, if it is the real end of its life, you might scrap it for parts. That would then be salvage. If you look at the original cost and you subtract the residual or the salvage value, that is known as the depreciable amount. In other words, that is the total amount that is a cost to your business over its entire life. And that is why we need to depreciate it. Because we are going to incur this cost over a number of years, for example, 5 years, you don't want to write off that entire cost in the beginning. And that's why we record it as an asset, not an expense when we buy it. But we also can't just leave it as, oh, we don't have an expense, because you really do. When you sell it, you are not going to get the full value back. So that difference, that depreciable amount, needs to be spread evenly across the useful life so that the actual cost for each period is in the correct period for the revenue that it is going to generate, because one would hope that this asset will generate revenue evenly across that period. The details of your depreciation, etc., would usually be recorded in an asset register, along with any other details of the asset so that you can keep track of it. It's very important for your actual control of your assets. So these are the different ways in which you can calculate depreciation. The first and most straightforward, and actually the most common used, is the depreciation on cost, or straight line is another term that is used for the same thing. And in this one, we just take the cost times the percentage. Or another way of doing it is saying the total depreciable value divided by the number of years of its useful life. Either way, you will get the correct answer. However, there is also a way of doing it, which many would argue is maybe more realistic to give you a fairer representation of the value of the asset if it loses more value in the beginning of its life. For example, vehicles. In practice, vehicles generally lose about 20% of their carrying value each year. So what you need to do for this one is, instead of using only the original cost, you first subtract the total depreciation over its entire life so that you can see what is it supposedly worth right now, and then you depreciate that amount. Now, because the carrying value is getting smaller and smaller each year, it means so will your depreciation get smaller and smaller each year. In practice, most businesses use cost. Very few use the depreciation on carrying value, probably because obviously IFRS requires that we want fair presentation and we need to link our expenses to the period in which the revenue is generated. And for most of our assets, the revenue would be generated evenly across that period, and therefore it makes sense to depreciate it evenly across that period. If, however, it would have more revenue in the early years, then you would want to use the depreciation on carrying value. The third method, which is only going to be examined from 2024, is your production units method. This is where you look at commonly a machine in a factory, although it could also be used for vehicles, so your delivery vehicles or whatever. And in this case, you don't depreciate the asset by, oh, well, how long have you had it? Instead, you look at how many units do you expect it to produce over its entire life, and then how much did it use this year? And this is quite a nice, accurate way of calculating depreciation, because obviously the more you use it, the more revenue you're generating. So it's linking your cost to your revenue much more accurately. The way that you work this one out is you take your cost less your residual. Just like I said, if we were doing straight line, you'd say cost minus residual to get the depreciable amount and divide it by the number of years. But in this case, you're going to divide it by the total number of units you expect it to produce and times it by the number of units that have actually been produced. If you're looking at a vehicle, you would use the number of kilometers. So you might say you expect to hold a vehicle until it reaches 100,000 kilometers, and then you're going to sell it. That would be your total units at the bottom. And then if, for example, 15,000 kilometers were driven in that particular year, that means you would multiply your depreciable amount by 15 over 100,000, and that would actually in practice be 15%. But what you're doing is you're just using the amount it has been used. So now we come to the disposals, which I know many of you find quite tricky. Quite simply, close everything off to an asset disposal account. In reality, you don't actually have to use an asset disposal account. I've seen some universities that don't use it at all. They just do a general journal entry with all the accounts as debits and credits. But for you, it is much easier to use an asset disposal account, and you are expected to know how to do it. And quite simply, it means you just take your cost, you take your total depreciation. Just remember the current depreciation also, because it's all the depreciation on that sold item up until the date of sale. And lastly, use the selling price. You throw everything into your asset disposal pot, mix it up, and your profit or loss will come out. So if you're ever asked to calculate a profit or loss on the sale, very often just drawing up the asset disposal account is a nice, easy way of doing it. So this is what it looks like. As you can see, you've got your cost in on the debit side because it would have had a debit balance because an asset increases on the debit side. You would have closed it off on the credit side, and therefore it comes into asset disposal on the debit side. Accumulated depreciation is a negative asset, and that's why it lands up on the credit side. And notice it's the original balance up to the beginning of the year on that sold item, plus the current depreciation on the sold item. You then pop in your selling price, and you can work out either that you would have a profit if the entries on the credit side are larger, because obviously it means your bank was bigger than it needed to be, or it would be a loss if your entries, if your cost is larger than the accumulated depreciation and bank. Now, when you are using your tangible assets note, keep in mind that your asset cost and your accumulated depreciation are the amounts that you are going to use together for the disposals at carrying value. But don't worry, we're going to go and look at it a little bit later, and you'll see there's a very nice, easy way of creating the note. The selling price over here is the amount that would go into the cash flow statement. As I mentioned when we were doing the cash flow statement, keep in mind that this asset disposal entry would be at carrying value. Your cash flow would also take any profit or loss into account if the examiner has been sneaky enough to put that in there. And then obviously your profit or loss, as well as the current depreciation and any year-end depreciation, would go into the statement of income. T accounts. Now, those of you who know me already probably know I love T accounts. And the reason is simply because it helps you to see what's going on very easily. If you're not used to them, I know it might take a little bit of time for you to get used to them, but do yourself a favor and just give it a try. If you hate them, you never have to do them. But this is what makes tangible assets one of the easiest sections if you can do it properly. The first thing is when you're given information, they will usually start by giving you some opening balances or a balance from a trial balance. If it's a balance at the beginning of the year, then it's easy. You just put it in at the top. But usually it's going to be a year-end trial balance figure that you are given. And because it's at the year end, I would always suggest that you create your T account, but you put it below the line. In other words, as a middle figure, leaving space above so that you can recreate any transactions that happened that were recorded, and there's space below to record anything that you still need to take into account. And you do that for both the asset account and the accumulated depreciation. You can then show any information that they give you above the line if it was recorded. Now, what I would suggest is that in your asset account, when they tell you there was something new or something was sold, as soon as you see the date, work out how many months did you actually have the item and put the number of months, X over 12, in the margin. Obviously, you wouldn't write X. You would go 5 months or 3 months or 8 months divided by 12. And you put that for each of these. That means that later on, when we're going to calculate our depreciation, it's going to be a lot easier. When they give you the depreciation figure, I would also suggest that you actually write it over here at the top of the asset account so that it's easy to refer to. Usually accumulated depreciation won't have items that were already recorded. The trial balance figure is usually the beginning balance, but not always. There are sometimes cases where something was sold and the bookkeeper for once knew what to do. Very unusual case there. And therefore they would have recorded it. And so it would be included in this balance brought down, which means that you would simply work out what the entries would be and show them above the line. This then allows you to work backwards to find the beginning balance. Below the line is where you will record any transactions that have not yet been recorded for whatever reason. Again, put in your X over 12 for any new items or any sold items in the asset account because it'll help you calculate depreciation more easily. You can then work backwards to find the beginning balance, taking the entries that were recorded into account. And you can work down later on once we've done everything else. To calculate the depreciation on the sold item in the middle of the year, use your asset disposal figures. Remember, I showed you your cost, and if you're using carrying value, then the accumulated depreciation. So if we go back and we have a look over here, you can see there's an asset disposal figure in my asset account. There's an asset disposal figure in my ACDEP account. Both of those would need to be taken into account if it's on carrying value. Obviously, cost, you'll only use the cost. You simply take the cost times the percentage times X over 12. That is why I wanted you to put it in the margin. You can pull the percentage from the top of the account where you've written it. You can pull the number of months from the margin. All the figures you need are right there. Obviously, if you're doing carrying value, you'll need to pull the cost from the cost account and the ACDEP from the ACDEP account. And you can pull the percentage and the number of months from your cost account and work out what your sold depreciation would be, and then go and record it in your ACDEP account in the middle of the year on the date of sale. If you're doing production units, you don't actually need X over 12 at all. You simply take your cost less your residual and you times it by the units produced over the total units. Because obviously, if you've only had it for a shorter time, the units produced would be less. So you don't have to factor in how many months you've used. When you're calculating the depreciation on old, this is a calculation that gets a lot of students because it's quite tricky. There are a lot of numbers that can go into it. It's 5 or 6 numbers, actually. And in the stress of an exam, it's very easy to confuse your pluses and minuses. So a very nice trick is simplify it. Look at your asset account, ignore the new item, because obviously we depreciate the new completely on its own. We are just looking at the old items here. To work out the old, you take your balance and you subtract the cost of whatever was sold. That's all you have to do. And you can simply see it in this account by ignoring new, because there's nothing else there. So you work out the balance in this account, excluding the new item, and you put it in your margin. Yes, I know your margin is getting quite crowded. Always make sure that for your cost account, leave quite a nice border around it. But by putting it in the margin over here, it's going to help you to see, oh, that is the cost of the old. And now you can leave it there. And we go and do exactly the same in the accumulated depreciation. Obviously, if it's on carrying value, if it's on cost, you don't need to do this. In the ACDEP account, obviously, there won't be anything on the new item. So you literally just work out an interim balance. What is the balance at this point? And you put that in the margin. I quite like to circle them in the margin and then pretend that the circle is an O for old. It's a quite nice way of remembering it. But once you've got your margin figures, somehow suddenly it's a lot less confusing, because now you can just take your margin figure over there. If it's on carrying value, subtract your margin ACDEP and then calculate the depreciation from that. So this is how it's going to look. If you're working on cost, it'll be just your margin cost by the percentage. If you're on carrying value, it'll obviously be just the margin cost less the margin ACDEP times the percentage. On production units, it's exactly the same formula, nothing changes. But again, it would be the margin cost of the items that you've actually still got there. To calculate depreciation on the new is actually one of the simplest ones, especially because the method of depreciation doesn't matter. There is no accumulated depreciation on new items, so you will always just take the cost times the percentage, and don't forget the X over 12. That will help you to remember that you need to calculate for the number of months by taking this from the margin where you wrote it. On production units, obviously, it's the same calculation. So this is now what your T accounts will look like. Your accumulated depreciation will need an entry for the year end. So you'll actually have 2 depreciation entries here, most probably. The first for the sold item, and the second for the old and the new, which you calculate separately. Show your workings in brackets, please, because you can get part marks. And if you've just shown a total and you've made a mistake somewhere, the marker will have no idea what you did and they can't give you part marks. So if you show your workings in brackets, you're much more likely to get credit for the bits that you could do. So that's what your T accounts will look like. Once you've done that, you can go work forwards and find what is your balance at the end. And then you are ready to do your tangible assets note. Now, even if you are only required to do a tangible assets note in the exam, I would immediately go and draw up my little T account somewhere in a space below it with 2 accounts for each column, for the cost and the ACDEP for each column. Draw it up as I've shown you over here. If you want to, while you're going, yes, you can pop it into the tangible assets note, but the T accounts are helping you with a lot of the calculations that otherwise are much trickier to do without them. So if we have a look over here, you can see that the basic layout of the note is saying, what was it worth at the beginning? What was it worth at the end? And how did it change? What are the movements during the year? When you're busy working this out, you can, if you had to lay it out for yourself, you can see it's very, very simple. There's just 3 parts to it. Luckily, you usually get it laid out for you. And you might just need to go and put 1 or 2 things in, but that's very easy. Carrying value is obviously cost minus accumulated depreciation. So simple. So you obviously can just put those in there. The movements, you don't need to try and memorize. As you come across anything in your T accounts that happened in the middle of the year, From there, you'll be able to see, oh, this was an addition, a disposal, a depreciation, etc. And you'll see that that's what we're going to do. I haven't actually written them in yet. The first thing that we do is we take the beginning balances from our asset and our ACDEP, and we can pop them in over here. If you want to just do the entire asset account first and then the whole ACDEP account, of course, that's absolutely fine. Just make sure that you work methodically, as always, so that you don't leave anything out. You can then show your movements. Now you can see over here in your asset account, I'm looking at my beginning entries, and on the debit side, I would have any of my new items that I bought. And that would therefore obviously be additions at cost. On the credit side, you can see the asset disposal entry, which is the cost of what I sold. Keep in mind that you would also want to use the asset disposal from the accumulated depreciation, so you need to combine both of them. Don't worry if you forget. You can just write disposals and put the cost in brackets over here, or even if you put the cost as your final answer, remember you're working in pencil, so you can easily change it when you go down to the accumulated depreciation. You realize, oh my gosh, look at that. There's asset disposal, and you can quickly go and change it. But I would show the workings of cost minus ACDEP in brackets next to disposals. And then you pop in your depreciation. Obviously, this is all the middle entries in the accumulated depreciation. Notice that you do include the depreciation on the sold item because it was still depreciation, because there was a period of the year when you still had the asset and you needed to incur that expense. Lastly, you put in your cost and accumulated depreciation at the end. And this is actually the main reason I like to use T accounts. If you are just looking at your tangible assets note, it's very difficult to calculate those end balances because over here you would need to take into account the cost and accumulated depreciation, and you often forget that. So do yourself a favor, draw up the T accounts, and then you can easily work out the end balance in the T accounts and bring it across. Then all you do is you work out the missing pieces. Obviously, you can calculate the carrying value at the beginning and the end by saying what is the cost less the accumulated depreciation. You can calculate the end also as the beginning plus minus these movements. And it should be exactly the same. If it's not, you know there's a problem. Please make sure to always use brackets around your negative figures. In other words, the accumulated depreciation and the movements for disposals and depreciation, because if you don't put the brackets, you will lose a mark for each one. So over here, that would be 4 marks. Not a good idea. Once you've checked that your answer is the same both ways, if it's not, you know that you have made a mistake. Even if your depreciation calculation was wrong, working from your T accounts, this tangible assets note should work out the way that it does.